So my name is Gilad. I'm a PhD student in the UK, and I'm part-time at this Wits Institute. Platinum's not I'm not a platinum expert, so I'm going to confess that up front. I actually work on finance and on something which is called financialization, which looks at some of the dysfunctional aspects of the growth of the financial sector. And my PhD looks at the changing nature of finance in South Africa. Some of what we did in this report links to that, but this was a sort of side project which myself and a colleague wrote a few weeks back, looking at the platinum sector. As Kevin said, I'm going to try to link a portion of our report, because I'm not going to go through all of it, and also deal with that and try and frame that in the context of inequality in South Africa. I just want to say I'm going to go through this, and then at the end I'm going to abuse this invitation to say something 2 minutes on what Thomas Carlyle called the dismal science of economics. It's just to say something general about, I think, economics and economic reporting. So one of the things that I think is most frustrating for people who have a critical approach to the sort of corporate line and the government line is that claims made by large corporates and claims made by the government institutions are not often deeply interrogated. And I'm sure all of you in your work have received these very nice press releases from companies which give you an entire story, and you can use that, and there you go, there's the work done. Unfortunately, everything which you receive from those sources is an extremely partial, very carefully angled view on the issue. And that's what we saw. I don't know if anyone saw in the course of the elite strike, but there was a website which the producers set up, which they had there, press releases and everything. And it's a very interesting read. This graph features prominently in a number of their releases. Now, the industry narrative is that we're doing terribly. It's a really rough time. There's been wage pressure. Wages form such a large share of our costs, and we really can't afford any type of wage increase. And they point to this kind of a graph which shows wages as half or just under half of the total costs, and it shows a loss. And that was the dominant, you guys can tell me, but that was the dominant narrative which I experienced as a radio listener and as a reader. But if you think about it, it's a bit strange. Firstly, it's 1 year. Okay, who analyzes what's going on in a sector over 1 year? And secondly, if they thought they were going to keep making a loss, they would close down, right? Okay, so this framed our initial thought, right? What's really going on? If we take a longer-term view of this sector, what do we find? And can we try and view the UMCU wage demands in terms of a longer-term time frame? So our report did. Looking at this longer-term time frame, it did three main things. First, it said what's been going on in the sector for the last 14 years. Okay, what has profitability looked like, and where have the profits gone? Who's got what slice of the pie? Secondly, and that's the aspect in this presentation which I'm going to be focusing on. Secondly, we said, okay, well, what do the wage offers and demands actually amount to, right? Let's move beyond just saying it is 12.5. What are the actual costs? What are the actual implications of the offers and demands? And then thirdly, what can we learn about those by comparing the actual costs to the last 14 years, which is a highly imperfect tool because the next 14 years might not be the same as the last 14 years, but we can gain some deeper insight into what the affordability issue might be is if we compare the actual costs in light of a much wider range and a much wider time period. So this is just a very easy graph of the platinum price over the last few years. And when we see that the platinum price starts to really accelerate around the early 2000s, which is the same time that we see an astronomical boom in, and I'm going to speak quite a lot of this period of 2000 to 2008, in which we see, and we can go on to the next graph, that the platinum companies actually do incredibly well in that time period. So we looked at a number of different types of financial trends, and I'm going to show you where some of the data comes from. I'm kind of trying to mix the presentation between showing you what the outcomes were and also showing you where we found them, because that might be useful to you. So this is operating profit margins, where we have the three companies who are earning at times 5 times what the JSE top 40 average is. And if you average it out over the various periods, you see that it's well above double the average in those boom years. And for the period as a whole, it's still about 10 percentage points or up to 20 percentage points higher than the JSE top 40 average. I don't know who's got an economics background and who hasn't, but an operating profit margin is the operating income divided by the net sales revenue, right? And that's how you see the profit margins. All of the data which we used, we spent, and this is a painful process, we can go on to the next one, is we took the last 14 years of annual reports, which are about 250 pages each, for all three companies, and we data mined them. Okay, you can try to circumvent this by using some of the databases. There is a Thomson Reuters, there is BFA McGregor, who compiles this, and you can get access to the data. But if you want to be 100% confident, you have to read the statements themselves. Never take seriously anything in the first 150 pages except of a report, except for the executive remuneration. That is all spin. Okay, all right. Some of it's obviously true, but it's all spin. What you want to do is look only at the audited financials. Okay, things which started, I don't know, in the last third. Okay, things which have been audited. Okay, because they can't fudge those, but they can find all sorts of ways of either making things sound better or sound worse than they actually are, depending on what the agenda is. So here you see just the two. This is all of these shots are from the Amplats 2013. I'm certainly not going to bore you with 42 different annual reports. So the fact that took me so long to do 14 times 3 in my brain is not a good sign. That's how we have Excel sheets, so we don't have to do arithmetic. Okay, so it's this over that which gives you the operating profit margin. If we go on, please. That's one way of viewing how well a company is doing. Another way of viewing it is to take, and this was a recommendation from an expert in the mining sector, which is to look at return on investment, which you can take various measures of, and we took the measure of free cash flow over capex, which is a measure which is very difficult to fudge, okay? Because free cash flow a lot of measures which are put forward, the companies estimate what their depreciation costs might be, and all sorts of other estimates, and you can play with those. I mean, there's no way of knowing exactly how machine X will depreciate over 20 years. You can't be 100% accurate on that. And so companies use these estimates as also a way of fudging certain things, whereas the cash flow can't be fudged, okay? And the capex can't either. So that's why we were recommended to use this. Anyway, in the ANC, the SIMS report, which is the strategic intervention in the mining sector, which I actually think is an excellent policy document. They do a whole range using international and local trends, and they say that a rate of return which is more than fair, which is a good rate of return in South African mining, is the risk-free rate, which is the long bond rate, which is 8%, and a 7% risk-adjusted premium. Okay, any company making that in South Africa is doing well. Okay, so we compared what the actual margins were to that rate, and you see that it's orders of magnitude higher. Okay, in some cases 10-20% higher than that, and in particular you see that in this boom period. So these companies are doing astronomically well, both from the operating profit margin and from the return on investment. If we can go on. So now the question comes, well, okay, who's benefiting? And this is where we come to trying to understand this issue in the light of inequality. So I don't know how many of you are familiar with the idea of value added, okay? But value added looks at the money left over, or the funds left over, after costs of production have been accounted for. And what it allows you to do is to try and see who's getting what slice of the pie, all right? It's divided in conventionally and like we did, between the profit, like labor costs, depreciation and interest costs, and taxation. Within profits, there are subsections, right? Because the profits are either retained or they paid out as dividends. Okay, so what value added allows us to do is really see the comparative share of the three groups who have some claim, which is labor, capital, and the state, right? And generally, value added is also an interesting political economy type of phenomenon, because it's not politically neutral. It shows basically what the balance of power is between those three sectors at any one time. So this is what the share of the pie looked like, right? Now there's a few crucial pieces to here. The first is the red, which is the labor share. Okay, so during the boom period, labor's getting a 29% share. During the last 5 years, it's 58, and during the entire period, it's 38. Okay, this is the share of the gross value added. Now the OECD figures, and the OECD has good databases. It's always useful to try and offer some kind of a comparison, right? The national average in South Africa for these 14 years is that the labor share is 59%, right? Including during these years, right? So that means that labor in the platinum sector is getting almost half, right? A little bit over half of the national average of what labor gets in the economy as a whole. Even if you take account of the period as a whole, right? Which includes this period where in the last 4 or 5 years, labor was receiving about average, it still comes out that labor is receiving in the period as a whole well below average for what labor receives in the economy as a whole. So these claims that labor is a substantial section of the wage bill, that's true, but it depends how narrowly one is prepared to take one's time frame, right? And how easily we're prepared to accept that we should look at the worst year that they've ever had as an indication of the fortunes of the sector. The other important thing here is the dividends. These are profits, which is divided between those which go to the state in terms of the tax and the royalty, those which go to other profits, and those which are paid out to shareholders. I'll just quickly, we can flip through this, but basically this is where the labor figure comes from, It's page 200 or something in the annual report. This is where the dividends, where the tax costs come from. This is 2013. Depreciation and the royalty costs. So you obviously have to know what you're looking for, but all the data is there. It's very, very, very time consuming and very, very, very boring. But it makes for a substantive. Okay, so this is what we've just seen in those reports for 2013. These percentages for 2013 are totally out of whack with the pie charts that we saw. Okay, Labour here is at 71%, because that's once again taking that 1 year very narrow viewpoint. Here is the entire 2000 to 2013 for Amplats. It was our aggregate figure. We can go on. So I'm just showing you a sense of how we compiled that. So now there's this question of the distribution between Labour and shareholders, and we're going to compare the dividends across between these companies and the national average in a second. But what we see is that in Amplats and Implats, money to shareholders is about equal to the labour costs. Now that is it's just unprecedented. Okay, you just don't see that when you spend enough time looking at financial accounts, that your payment to shareholders forms such a large share, and an equivalent share to your total labour costs. We can flick through. Okay, so it's not true in the Lonman case, and in general, Lonman's doing a lot worse than Implats and Amplats. Okay, so in economics, which probably some of you have a background in, there's been, and you won't read this in most mainstream economics courses, okay, which tend to be incredibly narrow and uninteresting. I really undergrad economics. It's I almost hung myself. Marginal utility, and it's just nonsense. So there's been a lot of interest in this idea called shareholder value maximization, okay? Which is we take for granted certain things that happen now as if it's always been like that, okay? That the economy's always been orientated towards shareholders receiving the most gains in the shortest time frame, okay? That's not how the economy worked in the 50s, 60s, and early 70s. Managers prioritized long-term investment plans, even if that meant very low shareholder payouts for 5 or 10 years. This idea that what corporates exist to do is in the short term maximize payouts to shareholders is a new phenomenon. I mean, always shareholders receiving a return has been important, but this very narrow frame of distributing money outward at the expense of retained earning for long-term investment is a relative, I mean, it's new in terms of since the late 70s, where it sort of picks up. Anyway, so what we see here is the well above average payouts to shareholders. And payouts to shareholders are in some ways almost a sideshow in the shareholder maximization, because what also matters is the capital gains, right? If you bought a share in Implats in 2000 for 100 Rand, you could have sold it in 2008 for 12 times that. Okay, that is completely out of sync with the JSE top 40 average. And you've got corporates spending money on something interesting to look at, I don't know if any of you have, is share buybacks, okay, which is actually quite difficult to get collated data on in South Africa. But companies who are buying back their own shares. Now, there's no long-term value in doing that. You're not investing in new plants. You are taking profits earned and you're buying back your own shares in the market. There only is one reason, and that's to inflate your own share price, which is another way of ensuring short-term gains for shareholders. And we didn't have time, but I wanted to plot when the share buybacks were on that like graph. And when I've done that for other companies, you often see that large share like buybacks are at points where the share prices start to go up. I'm not sure if that's the case here. So one of the things that we've also seen in these last 20 or 30 years is the alignment of executive interests with shareholders, right? Whereas managers in the post-war period may have been orientated towards some long-term view of the corporation, they've aligned the bonus schemes, both in terms of the cash bonus and in terms of the share bonuses, that corporates have a direct interest, that executives have a direct interest in the share price and in distributions, right? Which is a new phenomenon, and we've seen that in South Africa, where the share of the total package of the corporates of executives that is given out in equity, which is the green here, has increased. Okay, and we see that the gains on shares by executives over this 5-year period was 247%, which strips all the other gains made. So this is both contributing to a particular mindset and also to increased inequality. So this is the Amplats example, where the salary of the CEO is 17.5 million. 8.5 of that is in bonus and share schemes, and there's about 135 million in outstanding shares to 10 executives. This is not in the report. This is new stuff I'm doing for an article that's coming out next week. This is where this comes from, again from the annual report. What does this mean in terms of inequality in South Africa? Well, if you take that wage of the CEO and you compare it to Amplats's lowest 35,000 employees, okay, which is what's the A and B level employees. The A and B level employees earn on average 137,000 Rand a year, which is about 11,500 Rand a month. That works out to that the CEO is earning 127 times the average for the lowest 35,000. If you take it for the lowest of the lowest, which I think I said it worked out as 95,000, it's 185 times. Not only is this obviously, at least in my opinion, immorally high, okay, but it's actually also well in excess of the national average, which is a wage differential of 54 times, okay? So these platinum sector bosses are doing incredibly well. In terms of, you've all heard of inequalities measured in the Gini coefficient, right? Now the number, and like South Africa, which 0 being the most equal and 1 being the most unequal. South Africa is statistically the most unequal society in the world. And the number which is often referenced is income, this should actually say income inequality, which is 0.7%. That's the highest level of income inequality in the world. But one of the reasons I spent all that time showing you the shareholder payouts, okay, is that the actually and very interesting aspect of inequality in South Africa that is the highest is financial asset inequality, right? Which is 9.61. I think it might actually be 9.51. I don't know if I wrote that correctly. So you've obviously got a very small sector in South Africa who has access to the financial asset, wealth. The only people who have unit trusts and investments and own shares is a very small subsection of the wealthy. Most people in South Africa don't enjoy any level of ownership of financial assets. And we see that represented in that in that statistic. Okay, guys, I think I will. What the rest of the presentation has is the costing, which is basically I took all the statements made by the companies and by AMCU. I took the number of workers in each in A1, A2, A3, A4, B1, B2, B, and I calculated what the different offers and demands mean, both to the increase in the individual wage and to the total cost to the company. And the rest of the presentation has that. I can show you some of that if you want. I want to stop in a minute or two. So I will wrap up then now. So one of the interesting things which I want to point to from that data, and the only thing I will reference there, is that again one has to think critically about what the data is which is being offered by the companies. So you've got increases to the basic wage and to the package as a whole, and you have increases to the A, B, and C level, right? Now, increases on the basic wage are the highest, whereas increases to the package as a whole, which includes medical and pension and allowances and stuff, is lower, right? Increases to A and B are higher than to C. Now, the producers said on that same website in some release that the AMCU demands amount to 30 to 40% year-on-year increases. And I read this in half a dozen newspapers. It's a complete fabrication, okay? When you run the numbers and you look at the cost to the company as a whole in terms of the total package, which is lower than a basic wage, okay, and all three of the pay grades, A, B, and C, what you see is that the year-on-year increase is between 13 and 15% year-on-year of the AMCU demands being made, which is still high, but it's another illustration of the need to interrogate some of the figures which we receive from the companies. The last thing which I did was 2 or 3 days ago, which hasn't been reported on widely, and you can have, is I ran the wage figures for all 4 of the offers for the AMCU's demand and for the settlement. And I looked at who won, right? Okay, who has compromised more and how much the workers actually received. And that came out yesterday if anyone's interested in that.